We are zeroing in on Meta Platforms today, as Needham and Company maintains its hold rating amid growing concerns that the company's sprawling ambitions may be undermining its core competitive edge. This is not a routine maintenance call. It is a pointed warning arriving on a bruising session for technology, with the Nasdaq 100 already down 1.90% and the S&P 500 shedding 1.23%. When a firm is closely watched as Needham chooses to hold rather than upgrade into weakness, the market reads that as a meaningful signal about execution confidence and forward return expectations. Needham and Company did not cut its rating on Meta Platforms, but the decision to hold rather than buy carries real weight on a day when institutional investors are already re-evaluating technology exposure. The analyst commentary centers on what Needham describes as strategy diffusion, the idea that Meta's capital is simultaneously chasing artificial intelligence infrastructure, artificial intelligence-powered advertising tools, and metaverse development in a way that fragments management attention and dilutes return on invested capital. There is no single earnings miss driving this call. Rather, Needham is expressing a structural concern about whether Meta can execute at the highest level across too many competing fronts at once. The Needham hold lands in a macro environment that is actively punishing ambiguity. With the 10-year Treasury yield sitting at 4.70% and elevated across the yield curve, the cost of capital for long-duration growth assets is meaningfully elevated, which means investors require a tighter, more legible path to cash flow to justify premium multiples. When a company like Meta spreads its investment agenda across artificial intelligence models, data centers, smart glasses, and virtual reality simultaneously, the discount rate applied to each initiative compounds the valuation risk. Needham is essentially arguing that in this rate environment, strategic sprawl is not a luxury the market will continue to price generously without clearer proof of return. The most direct pressure falls on Meta itself, but the read-through matters for the entire mega-cap technology cohort. The Nasdaq 100 is already down 1.90% today, reflecting broad institutional de-risking from high multiple names. Google and Microsoft face the same scrutiny, as both have dramatically expanded their artificial intelligence capital expenditure profiles and both carry valuation premiums that depend on demonstrable ROI timelines. The VIX at 18.90 is not in panic territory, but the upward drift signals that options markets are pricing in continued volatility. Advertising-dependent business models at Meta and Google are particularly exposed to any compression in margin guidance that could accompany a sprawling R&D narrative heading into earnings. There are three concrete catalysts to monitor from here. First, the 10-year Treasury yield at 4.70%. Any sustained move above 4.80% would likely act as a fresh trigger for risk-off repositioning, hitting high-growth tech and putting additional downside pressure on the Nasdaq 100. Second, Meta's upcoming earnings call is the moment where management either validates or refutes the strategy diffusion thesis. Listen closely for any clarification on capital allocation priorities and return on artificial intelligence infrastructure spending. Third, watch the Nasdaq 100 as a sentiment barometer. If selling accelerates in megacap names, the index becomes the canary for broader institutional appetite in the technology sector. Needham's decision to hold rather than buy Meta Platforms is a disciplined, rate-aware call that reflects a fundamental truth about the current market. Narrative alone no longer justifies premium valuations when the 10-year yield is at 4.70% and competing capital priorities are visible. Investors who want exposure to the artificial intelligence advertising build-out need to see Meta's earnings call deliver an explicit, quantified capital discipline story before adding to positions. In a session where the S&P 500 is down 1.23%, the Nasdaq 100 is down 1.90%, and the VIX is pushing higher, the path of least regret is patience, and that is precisely the message Needham is sending. That is the one story that matters most today. Full breakdown is up. If this kind of deep dive market analysis is what you want every single trading day, hit subscribe right now and ring the notification bell so you never miss a breakdown. We cover the stories that actually move your portfolio. See you in the next one.